Testing, testing. Oh, look at that. We got the microphone going. Well, bam. Hi, okay, bro. Needed a few minutes there to get ready because actually I was watching the Bayonetta 3 trailer, which looks fantastic, and I'll have to buy a Switch. Right, we're gonna keep going on working on my pacing for this. First, let's open up my apple juice. Mmm, apple juice. I don't know what you're thinking. You're saying, okay, bro, apple juice is not carbonated. Why did it make that noise? And well, yeah, I don't have anything to say to that. Okay, let's dive in. As I said in my little Reddit post inviting you here, this is a big old news related stream because everything's news. It's all news. What we're waiting for quite a while was, of course, the inflation report, and we got it this morning. And if somehow you were trading under a rock, well, then you didn't see the incredible volatility that came with it. But yep, U.S. Inflation numbers came in up 1.3% for the month, and then year over year was still. So consensus estimates were looking for 8.8, and they got 9.1. So quite the surprise, slight surprise. I mean, we knew they were going to be bad, but even worse. Thankfully, it wasn't the 10.2% that came out in the fake numbers, the fake phony numbers that came out, I guess, middle of yesterday's trading day. But in any case, yeah, inflation is up. But here's the thing is, everything needs context. Everything needs, you need to look at the sentiment for everything. I'm not going to dress this up and say the numbers are good, but let's remember a couple of things. The CPI report, inflation is lagging. So, these numbers are likely peaking, as we've been talking about. We've seen a lot of stuff, on the charts, like bear divergences on the dollar and on the yields that suggest, inflation is starting to come to a peak. And I know we can say that forever and ever, but the fact is, this rubber band upwards, this bearish divergence it's getting pulled tight. It will break. It will break. And so, it also comes down to like what you're seeing in the world. Gas prices are starting to come down. Energy prices are starting to come down. It tells you that at the very least, we should be looking at some of the highest inflation numbers either now or maybe one more month. I don't know if something unexpected happens. But you can see here. So again, 9.1% was the year over year that came in. Really bad, highest in what 50 years? I think 40 years. But look, when you take out food and energy, and I'm not saying that you do take out food and energy because humans need food and energy. It needs to be included in the numbers, despite what the Fed might like to do sometimes. But when you take it out, you can see that the numbers aren't quite as bad. You've got up 0.7% from May to June, and then year over year, up 5.9%. Again, still not good, but certainly not as damning as plus 9.1%. And so, why am I reading these numbers? Because it tells me one thing. When you take these numbers as a package, all of these, where do they have? CPI is a package. Obviously, food and energy. You'll see here, but you've also got like transportation. Consumer discretionary, all this kind of stuff, supplies, and there's so many things that go into the inflation average that really the only thing left that is either not dropping and going to show up in a lagging indicator next month. The one thing that seems to be holding back both analysts and people who are speculating on inflation via the dollar and other indexes, what are they hedging against, would be shelter. And rent comprises a gigantic amount of spending in the US and everywhere, but especially in the US. Housing is a huge thing, and it's the one thing that has just not really budged. It hasn't been scary high yet, which could also invite the idea that it has yet to go higher, but it could also just hold on for a long time compared to everything else because landlords are obviously underwater from COVID, and they're greedy in general. So The one thing that is probably holding people back the most is what is shelter going to do? Um, is it going to go down with the rest of the categories in the inflation indices, or is it going to hang on? And it could, because it's more necessary than maybe anything else is the roof over your head. So shelter is probably the one thing that could maybe make the CPI numbers drag out a little bit. It's not any more likely than the numbers just going down from here on out, but it is one thing that I think is kind of worth watching. And I'm not coming up with that myself. This is from other analysts, numerous, basically everybody else but me, who's a real analyst. Has been talking about shelter and rent and stuff like that. So that's not coming from me. I'm completely relaying that. I'm not nearly as into the real estate and spending world. So yeah, I want to make sure that you're not giving me that credit or anything. What's up, Hania Boo? How's it going? We're talking inflation. Actually, we just finished talking inflation, but yeah, everything that we've seen on the charts suggests that it's either peaked or peaking. There's not a lot more room for it to go unless something societally defining happens in these next few months, and there can. We know what a financial crisis looks like. As of now, we're not looking at it. So it's looking like we're peaking or have peaked, and we'll, of course, need confirmation on that. First of all, with some of the further news coming out, and then, of course, with next month's numbers and looking at the charts to see what the individual categories are doing. We've looked a little bit we've looked a little bit at oil and energy already, and we'll continue to look at those. So again, CPI caused volatility this morning and in the afternoon of the trading session. So what do we have to look forward to? Well, first of all, why were these numbers so scary? And it's most likely because it's going to guide the hand of the U.S. Federal Reserve and what they choose for the interest rate hike coming in. What's today's date? The 13th. So I think they meet on the 27th of June. Is that right? Oh, right. It's up here on the chart. So in exactly 2 weeks from today is when we'll get the next rate hike. And okay, I normally say the next rate decision, except the decision, as you can see up here in the probabilities, is well made. It's not going to be an easing or no change. It's going to be a hike. So we can just say that. So the next rate hike decision will be on the 27th. Again, exactly 2 weeks from today. And yeah, you can just see how the probabilities have shifted over the past month and into today with the release of that inflation data. They were looking basically 75 basis points has been the consensus for the past month. It's shifted from 50 to 20 and then 10 to 90, 0 to 92 was yesterday prior to the release of the inflation report. And now with the release of the CPI data, well, the 75 basis points bet has gone down from 92 to 20. And that's because the 100 basis points rise potential has now come up as an 80% chance. That means, 4/5 of bettors, speculators on this think that we'll now see, instead of the 75 basis point rise that people were fearing, we'll now see 100 basis point rise. Sorry, I just got an email notification in my screen from Celsius. I'm sure that's already telling us the news we already know. So, speculators are now 80% sure that we'll see a 100 basis point hike, which is very aggressive from a Federal Reserve. Clearly it's needed. Even if inflation has peaked, I mean, it's not going to get below 6% for a while. It needs constant attack from all the tools that they can use. So it wouldn't shock me to see a 100 basis point hike. I don't necessarily hate it. My portfolio is a little nervous about it, but then again, with a forward-looking market and just the casino-style antics of speculators, even a 100 basis point rise could be some kind of just capitulation bottom, and we go up from there. It's really hard to say at this point how people are going to react. All we can really say is volatility. That's the general, reasoning, that we're going to see volatility on these days, regardless of how it ends up afterwards. But just to recap, what was once the scariest option 24 hours ago, the 75 basis point rate hike on July 27th, has now turned into a pretty scary 80% chance that we get a 100 basis point hike again in 2 weeks from today. And even so, look, even if 100 doesn't come to pass because Papa Powell is nervous about putting 3 digits on the board for some reason and getting called Volcker, it's still guaranteed that we're going to see a 75% basis point hike unless I don't even know what could possibly happen in the economical world that it would go back down below 75. I don't think they can. They'd be pulling some kind of nasty ripcord. Yeah, so that's that. So that takes care of inflation and rate hikes. As I said, today was very news heavy, so we're going to keep going. What does the rest of this week look like, and how could it affect the charts? Let's go to our calendar. So yeah, today was really all around the world. We saw China's balance of trade. And I don't know what I didn't track Asian markets today. There was other things going on. Of course, had the U.S. news, and then British GDP and whatnot. Canadian banking policy. So what are we looking at for tomorrow in terms of big things? It's again, I don't really care about Chinese GDP. It's a different, not my sector. I don't know how it reflects on the rest of the world. I'm not as good at that. So in the U.S., once again at 8:30 a.m. New York time, on release. Wow, I'm sorry, my mind just spaced. We're getting PPI, which is the producers. That's the wholesale inflation, manufacturing inflation. So you can see this is how producers pay for goods and what inflation rate they can expect from that. It is directly connected to things like CPI. It's just a different index, different part of the ladder, the inflation ladder. And so you can see May was 0.8. And they are currently expecting, what was the forecast again? Let's go back to the easier page where I actually know where it is. So the forecast is a slight rise, 0.9%. So not too bad. The question would be if we see it hold to that forecast, that's not too bad of a rise. It's still a rise. So I don't think it's going to jar the markets one way or another. It's just another piece of the puzzle that is the inflation peak, with everybody speculating on when it will be and what it will peak at. So again, that's PPI tomorrow at 8:30 a.m. New York City time. And on Friday, once again at 8:30 a.m. release hour, we'll have retail sales data for the U.S. with how much money the U.S. spends. Consumer makes up 30% of the economy. Retail sales are important. Previously, we had the shock drop in May. It was a negative 0.3% in retail sales. That was very bad and certainly helped with the plunge last month. Consensus for June is looking to be 0.8%, but the forecast is now actually lowered a little bit. That could take into account some recent press releases from companies. I don't exactly know where these two meet. I see 0.8% more on other sites and other analysts. So I tend to just go by the consensus, but it's important to see them both. So again, consensus for tomorrow would be 0.8% rise in retail sales. Forecast from some people seems to be a little bit lower. We'll see if this can if this can meet that. It would be, and again, let's throw that salt behind our shoulder. It would be a massive shock to see another negative number in retail sales because this is all it's month to month. So to see a drop a drop in May and then another drop in June would be just sort of catastrophic. But obviously, with the way percentages work, it should be a positive rise coming off that surprise in May. The May numbers, I mean. Tomorrow will be the June numbers, even though today is July. So it should be a positive number. The question is, does it meet or surpass consensus forecasts? And then a little bit later, we get the Consumer Sentiment Index. These are the preliminary readings for the U.S. They're done by the University of Michigan. Last time on Dragon Ball Z, June rang up at 50, which was as I joked about on stream, the lowest rating in American history since the creation of the Sentiment Index like 50 years ago. I even talked about is the index still valid? Does it need to be recalibrated if we're not even in a particularly bad way financially and it's at the bottom, or it's at a bottom? In any case, so last reading was 50, and consensus seems to be just under that, 49.9, 49.3. So they do think it's going to drop a little bit more. We might get a new lower low on the consumer sentiment index. Their preliminary numbers tomorrow at 10 a.m. New York time. They'll be revised over the course of the month, but it should give you a pretty good idea of where retail and consumers are at. Yeah. And so that's the news for the remainder of the week. I'll also draw your attention to, again, on Friday. That's the options expiry. There's normally volatility on any expiry Friday, uh, and then so specifically in July 15, which so I talked about either on stream or in a post. I can't remember. First half of July is a very bullish time. It's one of the most bullish times of the year for all indices and especially for tech. Now we get the back half of July, not as bullish, and in fact, it starts off with the July options expiry, which is historically the most bearish day of the year. In terms not in terms of percentage drop, but in terms of percentage red. It's red like 80% of the time or something. If you were a betting person, you would, you know, this isn't trading advice, but you would bet on red for options expiry in July. But there's always that 20% chance that it's green, but it is an extremely bearish day, historically speaking. And so again, options expire on Friday. We'll see how that goes. Last up, and so that's the news for this week. I'm not going to go into the upcoming stuff because there's too much stuff to cover. End of this week and next week is the start of earnings season. It's everybody on ETH Finance's least favorite time of the quarter because the K-Drop posts are longer and maybe more meandering, almost as meandering as this stream. So as you can see already on the homepage, they're lining up for the start of earnings. Looks like that's right. So financials are starting basically end of today, tomorrow. See what's coming. Oh no, these are old. These are Q1. Earnings whispers. Okay, so here's the calendar. Yeah, so barely getting started with earnings today. I guess Delta came in and whiffed. Shocking, but yeah, it's going to start in earnest. Earnings in earnest tomorrow. We've got financials coming up. J.P. Morgan Chase, Morgan Stanley. Switch to all. Oh, that didn't really change anything. But yeah, Chase, Morgan Stanley, TSMC, biggest semiconductor company on the planet. A couple other banks, and then Friday, just more banks. Wells Fargo, Citi, Progressive Insurance, U.S. Bank, BlackRock, PNC, and then this isn't a bank, but United Health is the king of the healthcare sector, which is a major sector and consumer defensive. So we'll see how that reacts to all this latest stuff. But anyway, financial earnings are going to kick everything off, and then boom, next week hits. What do we got? Oh, a few more banks here: Goldman Sachs, Bank of America, Charles Schwab, Synchrony, which is that company that runs all those crappy store credit cards. And then it's going to be basically just right into the biggest earnings of the year. You've got cleaning up a few financial companies, but you've got Novartis, Johnson & Johnson for pharmaceuticals, Lockheed Martin, Abbott Pharmaceuticals. There's Tesla next Wednesday. I know I could go through this. I'm not going to go through the entire thing because that'll take way too long. But yeah, tech earnings are starting, and it's going to be interesting to see how they all performed. If it's good, this could help us, prove that the market bottom is in, and that even though we could have a couple more hitches, that we're mostly heading up. But it's an important time. AT&T Thursday, Philip Morris, more pharmaceuticals. What's next Friday? Verizon. Yeah, so it's just getting started. Anyway, earnings season is coming. All right, that should do it for news. I think I've made your ears bleed with that. Let's get onto the charts. I'm gonna go really quick through equity stuff because it's a little bit easier from today now that everything's kind of in. Let's go to the daily. All right, so let's start from I've been bearish for long enough. So let's start from the weakest index, which was the Dow, and then we'll go from there. So yeah, Dow got hit hard today. It made the least amount of progress after the morning plunge. Um, did not really recover. It got stuck underneath 308. And again, this is the DIA, which is a proxy fund for the Dow, so it's not using the actual numbers. If you were to use the actual numbers, I think it was 12.8 was the Dow. Um, that is not what I meant to do. um, no, I'm thinking Nasdaq. Jesus Christ, Nasdaq was getting stuck. Okay, I'm talking myself in circles. So anyway, here's the Dow, weakest of the day, mainly because it had the least large bounce off of the volatility this morning. Got trapped underneath 308, which is roughly the 20-day moving average. Nothing's ever good when you're underneath the 20. It leaves plenty of room for more selling. It's not particularly bullish. Not really much of a pattern showing up. Because of the gap down, if there were to be some reversal tomorrow and Friday, you can use this gap fill as a little bit of a speed check, speed boost, but there's nothing on this chart suggesting that. I think it even because of the open today, actually set a lower low on this little sort of double top forming thing here. So Dow, extremely weak. You can see the momentum is shifting down, RSI shifting down back underneath the rolling average. So there's nothing to really talk about until tomorrow. Again, if it reverses, we'll talk about that. For now, bearish bias on the Dow. And then let's head to the S&P, which was actually the second weakest. Oh, let me hide these lines. Sorry, no reason to have those for now. And by second weakest, I mean it was just kind of what was expected. With the morning CPI report, it dipped down perilously, setting a sort of, again, like the Dow, sort of a new low on this little double dip. But I don't really count those. That being said, it's not bullish action. Even though it got a higher percentage bounce from the morning's volatility than the Dow, the S&P, again, this is the proxy fund SPY because I like it for the easier numbers. The SPY still got trapped underneath important resistance. You got first of all smacked right into the 10-day, which had been rising up above the 20 and a slightly constructive action earlier. Or actually, I should say at the end of last week, a little bit constructive, which is the word I now use for bullish action seen in a bearish context. I've been hearing that everywhere, so I like it. Anyway, the SPY today, shot up to test the 10-day, which was above at roughly, was at 382.5, and got smacked down. And not only was it smacked down, it also closed, much like the Dow, back below the 20-day moving average. Nothing good happens below the 20-day. It can bounce back up tomorrow. It can, again, close this gap as part of some kind of bullish reversal. After all, it was a high volume green day, which is something, but because it's back down below the moving average, you're not going to call this bullish. I would call it certainly bearish, maybe just not quite as bearish as the Dow was. What had me most nervous was, where's my cloud? I think I need to get rid of this. Let's go to the indicator. This is what was really bothering me. Oh, wait, we're still on the daily. Well, okay. Yes. Obviously, the SPY daily is below the cloud. We've been below the cloud since April, it looks like, when the April rally failed. So that's probably not going to, everybody's like, doy. No, it was the 4-hour turning back over again. So, the 4-hour, once again, on a little, 2-day rally or something like that, the SPY entered the cloud, got bopped right off the top of it, and just exited again today. With the morning's volatility, it of course plunged way out of the cloud, but not only that, when it recovered, it didn't recover quite enough. It bounced off the bottom, the bottom limit of the cloud and just closed red, clearly outside of it. That's bearish. That's purely bearish. Again, we're on the 4-hour chart, so everything with a grain of salt. This isn't. It's not as though we've flipped back over on the daily, but that's pure bearish on 4-hour. Not only that, take a look at the Stochastic RSI, stochastic. That's purely bearish. This this isn't guaranteeing like, oh, well, then K-Brot's saying there's a big old drop tomorrow. No, that's not what I'm saying. It's just bears are in control wholly and completely. It is their ball game to get things started, and yeah, we'll go from there. Not a ton of good things on the SPY. The momentum has rolled over. I think if we pull up even like, let's get rid of the cloud. You guys have seen that. Pull up like MACD. MACD on the 4 hour rolled back over. Again, another failure. Although we'll go to the daily MACD, and this one has me a little more excited. Was it on the SPY that I found it? There's a beautiful divergence forming. There's one on Bitcoin, which I'll talk about in a bit. Oh yeah, okay. So here, we're here on this is the SPY daily, and if you take a look down here at the MACD, make the RSI really small because I don't care about it right now. And you don't have to zoom in too much to see a nice little bullish divergence forming. You've got this long period of deep red on the MACD, and the fast moving average hit a maximum value of negative 11.5. So keep that in mind. And then we're going to move forward. We got the failed rally, which moved a little bit into the green. Pretty heftily into the green, but did roll over quickly and failing and move back down pretty deep into the red. But remember what I said, negative 11.5 was the last reading over here. The fast moving average of the MACD, we've got 9.2, 10.5, 10.6, 10.6, and then it rolled back up. That, my friends, if you were to draw a line like this, that is a bullish divergence on the MACD. Now, what does that mean for the pseudo near term? Well, clearly MACD is coming down, it's rolling over. Today's action did nothing to help that. So you can probably imagine with me one more, if this were to go in a fairly easy to read way, one more drop, maybe even setting a new lower low on the SPY. That's right. You know what I'm talking about. Breaking 363, heading to I have a couple of numbers picked out on my chart. 357 is one. That's an early spot to look at. 352 would be a great spot to front run the eventual hard line at 3,500, which is 350. You can imagine a lower low here on price one more time, scaring the pants off everyone, getting this deep red on the MACD, but the average maybe pulling up a little hair above there, like a 9.5, and continuing this bullish divergence. Short squeeze, rally back up, and then that being the bottom. Definitely something we're going to want to watch for, because that just sounds it's too predictable to actually happen. But boy, if it does, talk about a setup there. And we'll be able to say that we spotted it on the MACD. I'm going to leave the MACD up, actually, as I keep going, because no, I'll get rid of it for a second, because I did want to talk MAs while we do the rest of the charts. So, as I promised, we'll move into the oh shit, that's the wrong. Where's my 5? There you are. Okay, so we've got the SPY. Now the second least bearish chart of the day, IWM, small caps. And so IWM was, it had the same general movement as everything else. You've got stochastic RSI turning down. Bears are in control. Obviously, it gapped down for the morning, big volatility off the inflation numbers. But even though it too got rejected off its 10-day up here at 172, you can see they did manage to close it back above the 20-day moving average at 171, closed at 171.32. And as we know, there are no mistakes on charts. The whole market is run by bots. So if it closed above, it closed above, definitively so. And so, yeah, that's a constructive sign in today's nasty bit of action. So yeah, that's why I'm calling it the second least bearish candle of the indices. The breakout points, are still the same. It has to get above all of the indices we've gone through the SPY. They're all ranging. Didn't switch over. They all have this same range. You can see it. It's just consolidation. In particular on IWM breakout. Look, I'm not doing any kind of special math here, guys. Looks like 175, something in this area. Another, a third test of this area and a breakout of 175. Probably going up. Whereas the breakdown area is, the first one's probably going to be around this 168, it looks like. 167 maybe on the low of this candle. So 168, 167, because after, that's going to open the door to for bears to really accelerate downward past the eventual old low. Um, so yeah, I would say 175 to the top side, 168 probably get festivity started on the downside for IWM. Same rollover in momentum and RSI as the other indices, so definitely bearish, but probably the second least bearish. And lastly, we've got tech, everybody's champion today. You're looking at the candle like that looks like the same goddamn candle. But no, it was. I'll admit it's even less bearish than small caps. Just taking a sip of my old apple juice. So yeah, tech. It looks pretty similar to small cap, so I'm gonna have to dive in to why this one's a little more bullish. So same story. It's got the range in today. Had the mega gap down off volatility from inflation. However, even though it did also get the same rejection at the 10-day as the other indices, you can see that on a closing basis, there's hardly a gap here. I guess there is technically a gap, so there are probably open orders. What did this close at? 286.24, and this closed at 285.65. Okay, so there's a tiny little gap still on tech. It didn't close gapless audio. But it bounced back above the 20-day, similar to the small caps. You can see that the 20-day moving average 284.76, and they closed this bad boy at 285.65. That is demonstrably above the 20-day moving average. So tech is not ready to roll over and die. Small caps, probably not ready to roll over and die. S&P and the Dow, they're certainly weighing the options of just kind of taking a dirt nap. So anyway, with this candle looking pretty much the same as IWM small caps, why am I calling this even less bearish? Why did I give this one the title? Because of the king of the day. Look at Apple saving everybody's ass. This is the only stock that is like demonstrably up from like all this sort of boring, ranging, bearish bias action. Apple is moving up. I mean, no qualifiers about it. Higher highs, higher lows, bullish momentum. At least as far as Apple is concerned, bulls are in control. They're above. Look at these moving averages. You've got upward sloping 10, upward sloping 20, and they closed today again above the 50-day moving average. And the 10-day moving average is actually racing toward crossing upward on 50 moving average. So it's all just to say Apple is kicking ass, and as the largest corporation on the planet and the largest part of the tech index, you can see why I would consider it the most bullish of the bearish candles today. Okay, that should wrap it up for equities. There's nothing terribly exciting on our canary funds. Everything is just ranging. There is big money coming in, as we've been saying. Look, big money is coming in. It's not coming in droves, but it's starting to come up. Housing liked today's action a little bit more. Actually, where did it close in terms of the 50-day MA? So the 50-day moving average on housing 384.27, and they were demonstrably above it. So housing was fine. I think it was the only green index today. Yes, housing was the only green index. Multi-assets, it was green, but bleh. Multi-assets also had this horrifying red candle 2 days ago that I posted about. It completely undid the lovely big green candle the prior day. And high yield corporate bonds also like recovered off the volatility. Corporate bonds does have upward sloping 10 and 20, and it closed obviously way above it in a big green candle. That could be something to watch. Momentum is fully bullish. First of all, fully bullish, crossing down a bit because it was a down day. We'll follow that more. I'm not going to say much more about it because there's nothing developing here yet. Okay, what I really wanted to focus on today, because I want to go faster and more focused, is of course crypto, the dollar, and volatility. And I guess yields, really. But first, let's go into the VIX. So after all of today's action, what happened with the VIX? At first, it spiked up way above all the moving averages on the inflation report. It's like it hit about 29, and of course got smashed back down. Now, the volatility getting smashed back down is good. For sure. The question is, where did they get it under, and what did it, did it take any wind out of volatility speculators? So let's dive right in. I haven't spent a ton of time on VIX, and so I really wanted to do that today since we're already a half an hour in. I should say we're only half an hour in, and I've mostly gotten everything out of the way. So we can really dive in. On the VIX, we've got downward sloping 50 and 100. That's good. Oh wait, I'm sorry. That's yeah, 50. Sorry, downward sloping 20 and 50 day on the VIX. Downward sloping 20 and 50. So yeah, VIX has this shooting star candle, nice and red. They don't track volume on this, and it's below all the daily moving averages except for the 200. We do need to take a look at that though, because really, even though I say we're excited about this. I talked about this in a post. We're also used to seeing VIX well above 20 now. I mean, we've seen it at 20, 25. We've seen it at 30 for a while. That we see these numbers and we're like, oh yeah, it's getting smashed down below 27, guys and girls. 27 is nothing to cheer about. 27 is still extreme fear as far as the market is concerned. However, on days like today, we can confidently say that no new fear entered the market. So that's good. Not going to contest that. However, still higher lows. There's a low, there's a low, there's a low, and a bounce. So higher lows, and actually not quite higher highs. So it is kind of forming a little wedgy triangle if you go back to May. But we're just talking about right now. These are higher lows. This is a bounce for now. Even though no new fear entered the market, because of the way the VIX works with its spikes, I mean, this can turn around tomorrow at any time. And because it still hasn't, really the only chance we have of a breath of fresh air is getting below 24, which is where the 200-day moving average is. When we get, when we see the VIX below 24, that is like, or sorry, not below 24. When we see the VIX below the 200-day is when we see a real shot at a turnaround. And you can see that on the charts. When do we get our breaths of fresh air, in the market? We can start going back to here's the failed April rally when it got back under. Here was the the end of March rally was a whole, what am I going to call this? A whole sequence, a whole event. The VIX plunged from, what was it, March 14th, I think it was? Yeah, March 14th was like the bottom of March, and the VIX just plunged, got back below the 200. This was our chance, and then fund managers at the close of quarter rolled over all their assets and sold off, and the VIX went back up. But anyway, but you can see how that was our shot, getting back below the 200-day here. Over here, here's the the Santa Claus rally, big plunge in the VIX back below the 200, and then the market topped here on January 4th. Boom, straight up. And probably the most memorable one in terms of our portfolios is, of course, when the moving averages for the VIX, it was fairly subdued all last summer because of how well things were doing. And the VIX got smashed back below the 200-day on October 7th, which is when everybody should remember, that's when crypto saw its final huge rise. It started on the 7th. Actually, I think it started on the 4th. Sorry. I think it started around the 4th, which is the exact top of the VIX, but I had the 7th in mind for some reason. In any case, on the 7th is when it dropped below the 200-day, and, all the way through, was it November 8th? It should be pretty subdued. Yeah. Something like that. Here's the crypto top on November 9th. So VIX below 200-day is what we need to see before we can really take a breath. So yes, today's action was good, shooting star candle, but small potatoes. Got to get back under this white line, specifically back under 24. And even then, 24 is still elevated, just not relatively elevated. We want to get, ultimately, you want to get back below 20 to see a bull market, to see a bull run, I should say. So long way to go on VIX. But today was, decent action, and it got below some key moving averages, got back below, what is that, the 100? That's good. One thing to note is, what is the actual percentage drop? Because there's an interesting rule with the VIX. 9.75, that is close. So there's a rule that analysts talk about. And when the VIX has a move 10% in a direction, within 48 hours, it will have a spike in the opposite direction. And it's something that you can see. I mean, I don't even know if I have to measure these for you. I can look at this. This is definitely a 10% candle. Boom, green. You've got this. Actually, this one's unusual. But typically you've got, boom, 10% candle, red, 10% candle, green. and then red because it was huge, and then green. Like you can see how this like these 10% rules just played back to back to back. So 9.75 is not 10. It's pretty close to 10. Um, I would probably bet on a green day coming up. Oh, and I'll tell you why also. Actually, is there anything on the weekly we want to look at first? No. I mean, VIX green looks like the 20-week average is 26.79, which it's currently above. We'll see how that plays out. But what I wanted to do, since we're diving in deep today, let's talk about VVIX. That's right. The VIX itself has a volatility index. I love doing this because it's so funny to me. I loved physics in school, so like all the derivatives of stuff, how like acceleration is the derivative of jolt and all that kind of stuff. Anyway, so yes, there's a volatility index for the volatility index, and this is great. What's not great is that this has been, first of all, this is rising, and so this is the chance of the VIX spiking in essence. Now it can spike up or down, but coming off that red day on the VIX, it could lean more towards green. And with the volatility of the volatility picking up, that suggests an even larger move. In addition to that, the VVIX has been really subdued. I think you can see it's been pretty low on the RSI, and now it's starting to come back up. That could suggest a spike as well. You've got, at least today, now this is a red candle, so it closed below, but it did start the day back above the 20-day moving average. It's all just to say that, the fuel is being prepared for a move on the VIX. Could be green, could be red, but this suggests it's coming. And if you look at the weekly, I mean, the volatility has been really subdued over the course of this year. And now it's been subdued in the green direction for the VIX. The VIX has been going up, but it's been going up at a fairly subdued rate. Reduced volatility on the VIX all since January. Obviously, that led to red markets, but the volatility has been going down, which, as we all know, with even just looking at the regular VIX, when the VIX is going down, it's eventually going to spike. That's just how the markets work. So if the VVIX is going down, you can also expect this to spike. It works in a very similar way. And it looks, kind of like a volcano starting to grumble. It's you could make the argument that it's overdue or becoming due for an eruption. And you can see that sort of in the momentum here. It's been bearish I would say lean bearish to subdued. I'll say that because obviously up here is not bearish, but certainly subdued as it hasn't broken 50. Hasn't broken 50. So in 2022. So let me just restate that the VVIX has not gone above the bullish mark in all of 2022. So we're due for one. And what happens when it spikes? Well, you get Omicron drops and stuff like that. Over here, even just down on the regular RSI for VVIX, and I know we're taking derivatives of derivatives of derivatives. I understand. I don't want anybody coming at me and being like, oh, you can't look at the VIX geometrically. I know. I'm the one who says that all the time. But we got to use every tool at our disposal. Down here on the RSI, you can see the VIX has been, once again, subdued all throughout the year. It's been pushed underneath the slow moving average all throughout the year with a couple of spikes. Here's the June drop. But already you can see it back to rolling over. And the more times you test the slower moving average on any kind of oscillator, the more chances it has to finally break. So once again, there's a real chance at VIX's own built-in volatility breaking upwards. Now that could send the VIX down to 24. It could send it to 20. Maybe the volatility breaks, in our favor. But with how the VIX has been shaping up, sort of subdued on its own, suggesting that a green spike is next. It could be going in that direction. And as we've talked about before, there is still one more gap to fill on the VIX for speculators, and that's 47, which is based on the COVID spike. This weekly close, you've got, I think it's 45 to 47 is the key. Yeah. So here's the closing basis for April 13th. Actually, here's the opening basis, I should say, for April 13th. And then here's the closing basis for March 30th. And boom, you've got this gap, 45 to 47, which has never been filled. You haven't even come close to it. I guess we came kind of close to it here, but if you zoom out, it looks a lot farther away. There's still a lot of room for volatility, and we haven't seen the spike. And as we talked about on a prior stream, you tend to see spikes at the bottoms, which would suggest that maybe we haven't seen the bottom yet. Here's the COVID bottom. Here is here's the Christmas surprise in 2018. You've got the early 2018, the repo not crisis, but I forget what they called it, repo strike. Maybe it's the repo crisis. But yeah, you had two of them in 2018. You had two bottoms in 2018. If you guys don't remember, you can see them on the SPY. Here's the early one. Here's the late one. I could keep going back, but you can see it on a prior stream. There are spikes in the VIX at market bottoms. Here's the great financial crisis. Here's the Fed pivot of 2011. All right, I guess I will do this. And finally, here's the oil crisis of 2015. So it keeps me up at night. This gap exists, and we haven't spiked like we typically do at the bottom. It does have to stay in the back of your mind. Let's take a look at the dollar, which I know I've been saying, and people are tired of hearing about this bearish divergence on the dollar, but it's still there. Look, you've got from May, price at 104.50. We're currently at almost 108.50, which is the top of the range I've talked about in some posts. Higher high on price, and the RSI is still a lower high. Higher high price, lower high RSI. That is a bearish divergence on the dollar, which should be a bullish divergence for equities and crypto. And it's still in play. And I'll keep talking about it until it's not. Now, divergences, as we've said, do not have to play out, but it's a great tool, first of all, and second of all, on a time frame like the weekly, it's powerful. So it's a powerful tool. We need to look at it. On the daily chart, there's not as much exciting to say about the dollar, except that it does kind of, it's showing what I just talked about. That rubber band is getting stretched. It's putting in, higher highs, but it's taking an awful lot of bull energy. That is dollar bull, not crypto bull or equity bull. It's taking a lot of bull energy to keep it up here. You see, it's been in full bull momentum for, really the entire month. And in fact, it hasn't even dropped to, the bears never. Okay, it dropped. So for one day, bears on June 28th, the bears had control of the dollar, which would have been a bullish day for the market, traditionally. But overall, it's been either upward momentum into bullish or just full bull momentum since early June. So there's nothing to say here structurally except that we're just waiting for that divergence to play out. And when it does drop, how far can they get it to drop? Otherwise, there's nothing really to speculate on here. It just looks stretched out. Let's quickly take a look at yields, which we're doing the same kind of thing. On the weekly, we saw the divergence play out. We had price here, higher high price here, lower high on RSI, and it looks like maybe our first divergence is playing out. This is, again, a bearish divergence on the 10-year yield weekly. Could be playing out. It's certainly starting to kind of falter. And that would be really good considering the yield curve is fully inverted. It would be nice to see this start flattening at the bottom here. Of course, with the caveat that, as I've discussed before, the yield curve inverting, plunging, isn't when recessions happen, which means even though we're potentially at a local market bottom here, and I do think there's one more upward movement yet to come, we do have to keep an eye out for when the yield curve rips back up, because as soon as it rips back up and finds equilibrium, that's when the recession hits. And you can see that going all the way back. Here's the 1990 recession. Yield curve inverted back in 88, actually. The Fed started acting, they were using their policy to right the ship, and it bounced up and down and up and down and up and down, but it wasn't quite the recession, and then it shot up past equilibrium and stayed up, and boom, September 1990. There's your recession. Let's fast forward a few times. This one, I believe, so people talk about this one, and admittedly, I would probably just call it an exception, but there are far more intelligent people who would be able to discuss this, because here was the yield curve inverting and ripping back up to equilibrium, but the recession didn't happen in 1999, obviously. Why didn't it happen? I don't know. It's the only major exception on this chart. Some people Some analysts have said that it was that the .com implosion, which led to the recession. Um, some analysts do say that it was a two indicator recession. It just required double indicators because, as we know, as we've said, on average it's about a year to a year and a half from the yield curve inverting to the recession. So if you figure, this ripped back up in November 1998, if you really stretch it out, so like a year and a half from there, puts you in the middle of 2000, and things were still going on. So maybe it was, maybe the 98 surge was the lead in for the .com crash recession. It was just super early. But in any case, as we saw in 2000, yield curve inverted again, flattened out, ripped back up past equilibrium, and then boom, once it was past equilibrium, 2001, there's your recession. Same thing for the financial crisis. Plunged down in 06, stayed down here all throughout 07, and then ripped back up through the back half of 07, got above equilibrium, and actually, let's just say it crossed above, what is that, the 200-week moving average, hit equilibrium, and then boom, there's your 2008 right there. The 2019 inversion, it suggested that it was kind of, it either heralded the COVID crash, or it's just doing what the .com one did, where it's the first of two indicators for this upcoming recession, which is becoming increasingly likely because now here's the yield curve inverting again. It'll bounce back and forth as the Fed tries to toy with it. Eventually, it will ramp back up parabolically, probably back above this 200-week moving average. It'll reach equilibrium, and we will be in a recession. Another one to look at for yet another example is the bigger one, the last one that this hasn't inverted yet. Every other yield curve that analysts use has inverted except for the 10-year over the 3-month, and you can see how this is nicely predictive as well, at least in terms of COVID. It may have actually even been closer. Yeah, it ripped back up right as COVID hit, because that was like March 12th, I think it was. So this one has yet to invert. It is plunging. It's at a low today of 0.6. It's currently just above that. But, once the 10/3, crosses, as you know, these things happen in explosive moves. That could be our next indicator, and that could stay buried down here again for a few months until it rips back up and we get our recession. That takes care of the yield. I think that should do it for everything. Now let's dive into crypto. As far as the range, as far as the numbers in the range are concerned, we'll just take a look at some big targets. There's not a whole lot of, TA to do on crypto right now because it's so closely following the markets, and we already did market analysis. I will say there are some pretty obvious targets. These are some lines I drew early in the week. It's not. It just shows how bots control everything. If I drew these from like basically the low, the June 18th low to the next spike low, and so it was only drawn through here. You can see the line went through, and boom. I mean, it's just constant bots hitting that line, hitting the line over and over again. I'm sure we'll hit it again as we have a good chance at rolling back negative tomorrow. So yeah, I would just say there are some targets to hit. It's nothing super crazy. It's the range we've been talking about for over a month now. More or less, 22K gives it a shot to move up, probably back up to like this 25K bottom over here, low here. It's probably like breaking 22K sends it to 25K, maybe even 26K to like into this candle, start climbing this candle. Depends really what the moving averages are if it were to break out, when it breaks out. Of course, you're going to have major resistance again at the 200-week. It's been resistance 3 times already. Basically every week except this week. This week we haven't gone up to try it out. When I say we, I mean Bitcoin. So right now the 200-week is at 22.6. It's probably gonna, I don't know if it's going to completely flatten there at 22.6, but that's a good area to watch. It will be major resistance. You can see it's also, oh, how nice is that? It lines up with this little upward resistance line I drew haphazardly. So 22K, and then of course 22.6 will be kind of the push through that would be required to get it to 25K and above. With the way the equities are looking, if Bitcoin follows, we do need to keep in mind some downside targets. 19K has been the major one. Let's go to the daily actually to take a look at what it did there. So yeah, 19K we've had drawn for a while. Ready to bottom on the CPI data plunge this morning. I think it was 18.9. Is that correct? The low of the 18,901. Nothing more to say about that. TA deniers in shambles. Hit the line exactly, bounced off, and everybody's currently happy. And people are probably like, "Oh, it's a busted triangle," except it's not. This isn't a triangle. This is a range. But yeah, so Bitcoin and Ethereum got a nice bounce. It actually worries me that people are getting. I hope not too many people are getting drawn into this liquidity pump because look at this. You've got first of all, well, Bitcoin did it days ago, but close below the 20-day. Nothing good happens below the 20-day. That's when sales happen, and it was firmly rejected from the 20-day, which is at 20.4. Currently, it looks even in just the couple of hours since the daily rolled over, it was already rejected once at the 20-day, which is just under 20.4K. The high so far, again, we're like an hour into today, 2 hours into today, but it was already bounced 20,405, already facing resistance at the 20-day again. And to make things worse, the 20-day has rolled over again. So not only are we below it, not only is Bitcoin below it, but the 20-day moving average has rolled over, downward sloping. That's a bearish bias. There's not much more to say about that. Can it break through? Of course it can. This is crypto. This is Grandpa Bitcoin. It can do whatever it wants. More than likely, it's going to follow the markets, which were looking kind of iffy. As we showed, everything's got a bearish bias at the very least. So even though you've got this, look at this momentum shift up on the stochastic RSI. Oh boy. Well, look, it's still still middle of the road. RSI is well below 50. Downward sloping 20-day. I mean, it's a bearish bias. So right, I was going to talk about targets. So 19K, if it doesn't hold for some reason, if equities drag us down and we get a new low, well, first of all, 17.5 is the old low. That's where our beloved donut indicator. This is we pinned it to the exact week when the bottom would be. If it holds, it's kind of a win-win. If it holds, then we've got a new indicator to track for coming cycles, and that was at 17.5. That'll be major resistance, of course, if Bitcoin breaks 19K. But I don't think it would hold again. Frankly, I think there would be too much bearish momentum. The next one would be 16.5, which is where the 300 week is roughly. It's changed a little bit since I made that, but it's close enough. I think it's at let's get an exact number for you. The 300 week is at 16.850. Here, I'll raise it up. Actually, you know what? I'm not going to raise it up because, frankly, if Bitcoin gets to this area, the 300 week at 16,850, it's going to overthrow it by a bit and probably smack off the 16.5. So I'm going to leave it. But that is where that is derived from. And the second major target, this was calculated from, let me bring it up. Let me bring up the Bollinger Bands. You'll have to trust me a little bit because I already did the math before, but I'll explain at least where this comes from. So if you took into account the last time we broke negatively through the Bollinger Bands, they were roughly, I think it was like, I calculated it here, and this was like a 13 or 15% drop, something like that. This is 25%. Jesus. All right. Well, I did the math correctly back then. I just didn't remember the numbers. So this was, oh, wait, no, I'm not calculating from the bottom of the band. Bottom of the band was here. Come on. Okay, close enough. Negative 20% there on the May drop. And I believe this one was, I remember doing like 15%. So it's like somewhere around there. It was also 23%. Okay. Well, I did the math correctly before. I just forgot the numbers. So I calculated it as the next plunge through the Bollinger Bands would be here. This is if it falls out. You can see the Bollinger Bands expanding already. They're getting ready for action to the downside. If it were to come, this would be the lower limit, and it ended up around 13.5. 13.5 actually works really well because it's a massive. Where's my. Let's turn this off so I can get my logarithmic back. 13.5 is, of course, a humongous support point for Bitcoin. I mean, huge. Inflection point here in the 2017 top of the market. Resistance point in the 2019 fake out rally. And then again, you saw them dawdling around. It was hard to break it during the 2020 breakout that would lead into our latest bull run. So 13.5 has just gigantic amounts of support. It would be stunning that if Bitcoin got down here in a breach, I would be stunned if 13.5 didn't hold. We'd have to really dig into our souls and think like, okay, this market is very, very different. What are we going to do with this? I could see it overthrowing the line a little bit, like maybe hitting 12.5, maybe 12K to like spook people. But I personally, I would be pretty freaked out if 13.5 didn't hold. So those are the next targets, the next major targets for Bitcoin on the way down. ETHUSD is just as Bitcoin is at the whims of the equities market right now. So is ETH mostly at the whims of Bitcoin. We can kind of speculate on what the ratio might be. Major inflection point is, of course, 0.05, sorry. One being a whole number, and two, because we've hit it multiple times before. You can see these bounces back in the 2017 market. Boom. 05, like just all these battles around. There's 05, inflection point, inflection point, inflection point, inflection point, support. And then again, support back in June. As you can see, we kind of bounced off it. It starts to lose the exact value, doesn't hold up, at every time, but it's close enough. Clearly, you can see all the battles around 05. That would be our first major point. And the next one would, this isn't rocket science, but the next one would be, it looks like just above 0.04. Probably take like, if you do a line of regression here, I think 0.42 looks like the closest. You've got the local top in February 2021. You've got the high of August 2020. You've got all these battles back here in at the bear market bottom, actually, in 2018. So I would guess 0.42 would be the next thing on the ratio to look at. And again, it could overthrow it and head to 0.4 or 0.38 or something like that. But that's the general area that I would look at for the ratio in that case. So that should do it for today. I've covered everything, and yay, I did it 13 minutes faster than before and with a whole lot more content in the news section. So that makes me happy. I'm starting to get faster at this. Yeah. Oh, thank you, Jasper. Do you guys have any questions? Anything you want me to look at? I kind of I didn't really touch energy and oil today because I want to keep this to the hour mark, but it's coming down, which is good. We don't want it to come down too fast because that means a recession. But a nice trend down would be nice for energy, nice for equities, nice for our wallets. So this is oil, which is nicely coming back down, which is good. We don't want it to plunge. Yeah, let me know when you have your question. We'll take a look at what we can. Here's natural gas. Same rules mostly apply. Long-term holder realized loss. We can actually get that from. Is that the MVRV? I think. We can take a look at that. And I guess the short answer to your question is I do think it's important. I think it's a good tool. It tends to line up with other tools and trends. So I want all the tools possible. So I definitely want to look at that. You know what? Actually, it's not MVRV. MVRV is transaction price for Bitcoin, which is it looks very similar to I think what you're asking. Hodl waves is one good one. Oh, SOPR. Thank you. That does look correct. I wonder where we can track that on here. Hold on, I wonder if that looks bad. It looks like Blastnode has one on TradingView. Well, that's very nice. Can I open it? Hey, look at that. Interesting. So how is this lined up with prior bottoms, for example? So we've got, here's the market bottom, 2018. And thank you for pointing me towards this. So it looks like it bottomed out. We're on the weekly here on SOPR, and it came a month before the market bottom. So the market bottom December 2017, or sorry, December. I keep saying that December 17, 2018. So it actually ripped back up. So let's check out the values it was at. It looked like it hit below 0.95, which is that a historical level? Pretty historical. You have this 2011 drop, but I'm usually, when I look at trends and graphs back in this period, I mean, the low liquidity and the high volatility of that era makes me not really look at it as closely. So with that in mind, yeah, it looks like 094, 095. This area is a historical low, is a historical bottom. One that could be worth tracking. It's a little scary that we're nowhere near it right now. Although, I say we're nowhere near it right now, but as I've said, I do think there's one more bull run coming before we hit this recession. So maybe all this chaff on the way down happens here over the next year. And if we get that recession in 2023, like a lot of the other charts are suggesting, maybe this chaff, all this dropping happens over the course of 2023, and we hit this historical low 0.94 in some hypothetical recession plunge. Trying to see how it corresponds to other things. Yeah, because you can see it wasn't at the historical bottom in March 2020, which was technically speaking a fake out dump, because I mean it was a recession, but it lasted for like 2 weeks, so it's really hard to analyze that. But good that on this chart it didn't hit that historical bottom. It's not like long-term holders were suddenly selling off crazy amounts. They were accumulating, as we now know. I'll just quickly look back. 2015 bottom. So 2015 bottom was in January of that year. And it looks like in the lead up to January 2015, it wasn't at the historical bottom, but it did have to hit it first, kind of in December 2013. So there's definitely something to this. I'm going to have to look more into it because it's not lining up super closely with bottoms. March 2014 was when it ripped upwards. And it was a local bottom, or approaching a local bottom. So I think there's something to it. But I'll have to look into it more. But I do appreciate you bringing it up. I will add it to my list of things to look at because it's curious. I don't know how to use it yet, so I'll look at more trends. If nobody else has any other questions, I'm going to finish my apple juice in my chair. And oh yeah, absolutely, man. And again, I wish I could be a little more help today. I'm gonna look more into it, and then I will come back to it either or on a subsequent stream we're gonna post. So I do want to look more into it and see how it lines up with other trends. So thank you for guiding me towards that. Thank you everybody for joining in today, and I will see you next time on 51% Attack. Take care.